Welcome to today's presentation on the state of Azzad Asset Management. We're using this opportunity today to give our clients and friends the chance to see how we're doing as a firm, in addition to offering updates on the markets and our work overall. I'm Joshua Brockwell, Investment Communications Director here at Azzad, and I'll be your host for today. Today we'll look at 4 key issue areas. First up, Azzad updates last year up through today. Next, what drove market performance in 2023. Then, where we are now. And lastly, next steps. For those who may need a refresher, here's a look at who we are. Established in 1997, approximately $1.4 billion in assets under management as of earlier this year, and specializing in halal financial planning for retirement, college, investing, charitable giving, and estate planning. As a reminder, we are a full-service financial planning advisory firm. Here's an overview on your screen of the services that we provide. From investment planning to tax and charitable planning to halal financial services, we have positioned ourselves as the leading provider of halal financial services in the United States. 2023 was another year of awards and recognition for our firm, which also incidentally celebrated 26 years in the business. The year marked our second time being named to the CNBC Financial Advisor 100 list, and it was also another year of being named to the Financial Advisor magazine's RIA ranking. The awards keep piling up. We don't do it for the recognition, of course, but it's nice when people notice your hard work for clients. Be sure to visit our website to learn more about the criteria required to achieve these awards. Moving on, a quick update on one of our value-added services, shareholder advocacy. Azzad engages in shareholder advocacy on behalf of our clients, including proxy voting, filing resolutions, and engagement with company management. Some of our recent advocacy efforts are shown here on your screen. This year, we're continuing to work with our partners in the faith-based and socially responsible investor community to make sure that we take action against companies that cooperate with China and its oppression of religious minorities. You might remember that last year, we convinced Apple to disclose the App Store applications that they censor at the request of the Chinese government and to report why they did so. And that included Quran and Bible applications. This year, so far, we've pushed biotech company Thermo Fisher to stop selling DNA harvesting kits to Tibet and to report back on its pledge to stop selling the same kits in the Muslim Uyghur region of East Turkestan in western China. As we remember the ongoing war in Gaza, we want to let you know that investors have a role to play in conflict resolution. Acting on behalf of our shareholders, Azzad has been working to engage companies implicated in the violence. Here are some of the recent actions we've taken on the issue, including successful action in 2022 to pressure General Mills to abandon its Pillsbury plant in occupied East Jerusalem. Sadly, there are American companies that support the occupation through business dealings with Israel, companies like IBM and Motorola. We are working to push them in the right direction as well. Switching gears to investing and how we're putting client assets to work, let's move on to the portfolio allocation changes Azzad is making this year. Overall, there isn't much change in the 2024 allocations, a very small increase in large growth, but they remain pretty much the same allocations as last year. Some of you may be wondering, with all the focus on large cap US tech companies lately, why isn't that a bigger focus in our 2024 allocation update? Well, just as a reminder, we focus more on strategic asset allocation to deliver risk-adjusted returns for our clients. So rather than chasing a particular asset class that includes large growth stocks, you want to make sure the bulk of your assets are in a risk-adjusted diversified portfolio. As investors, we tend to extrapolate recent history to set our vision of the future. This recency bias, as it's called, has clearly pointed us in one direction, and that's US large cap technology. However, if we zoom out, over the longer term, market leadership is often more dynamic than what the recent past has instructed. We believe that broad exposure remains the best way to seek risk-adjusted returns for our clients. In other words, we seek out opportunities on a forward-looking basis, and simply put, large cap technology stocks won't always be market leaders. Moving right along, here's a look at the modeling tool we use in conjunction with our outsourced chief investment officer fiducian advisors to help construct those allocations we just saw. It seeks to enhance risk-adjusted investment performance. It drives our integrated asset allocation approach. It delivers robust scenario analysis to strengthen our decision-making process, and it allows us to tailor an investment objective or strategy to fit your aims and objectives. If you're a client, you may be wondering if you need to do anything at all with this information. Well, if you're in a non-taxable account, subscribe to one of our 5 allocations, you don't really need to do anything unless your financial situation has changed. If you've moved closer to retirement or possible job loss, please reach out to your advisor. It may be time to reassess your asset allocation. Otherwise, we will be rebalancing your non-taxable account before the end of this month. A few of our clients may have gotten carried away and may be outside of their appropriate asset allocations, or perhaps you're unsure which allocation is right for you. In that case, please reach out to your advisor. Sometimes clients have their accounts with multiple advisors. That does pose a risk, I should point out, in that we cannot analyze your entire financial picture. You may end up being far more aggressive or conservative than you should be. Remember, one part of our value proposition here at Azzad includes asset allocation and rebalancing. And speaking of those macroeconomic conditions we talked about a moment ago, let's now take a look back at Wall Street analysts' initial predictions for the stock market's performance in 2023 and how stock markets actually performed, as well as some of the factors that drove that performance. The S&P 500 closed at 4,769.83 at the end of 2023. That was a gain of 24.23%, well above the most optimistic expectations of the major Wall Street analysts. In fact, as we can see, forecasts fell well short of how stocks performed. There may be several reasons for this. The first reason was that many observers and economists really expected a recession in the first half of 2023. It never came. They saw higher interest rates and bond yields as depressing stock returns. Also expected by most experts and investors alike was the swell of AI, or artificial intelligence, enthusiasm. Few imagine the progress, widening interest, and implementation of AI, though. As AI developments unfolded, they sparked a powerful lift in tech companies, as we just mentioned, and that buoyed the rest of the stock market. Stocks also benefited from falling yields as inflation decelerated faster than many had anticipated, leading to hopes of a Fed easing. Despite periodic worries over the health of regional banks and episodic worries that the Fed may, in fact, remain restrictive for longer than hoped for, stocks did move higher, closing strongly in the final 2 months of 2023. I will point out very quickly, when we talk about the S&P 500, remember that that's a composite index. It's unmanaged and is generally considered representative of the U.S. stock market. Index performance is not indicative of the past performance of a particular investment. Individuals cannot invest directly in an index. Moving right along, let's talk about some of the factors that led to the market situation in 2023. Well, after disappointing 2022, stocks moved higher to start the year and continued higher for the remainder of the year outside of a few notable retreats. I want to draw your attention, though, to the plot points on the graph because they highlight the key storylines that really drove stock market performance in 2023. They come down to 2 broad themes: the track of inflation and the U.S. Federal Reserve, America's central bank. As you can see in the early part of the year, the Fed's still hiking rates in the face of still too high inflation. Nevertheless, the market is moving higher perhaps for 2 reasons: bargain hunting and anticipating inflation will moderate, and that the Fed will eventually stop its rate hikes. As we look at the data points later in the year, sure enough, inflation is coming down, and the Fed is now pausing on further hikes, so much so that by the December Fed meeting, it is signaling rate cuts for 2024. Of course, markets never move in a straight line, something always to be aware of. There were some hiccups in this advance, and one of these hiccups was the so-called regional banking crisis that happened in March, and some backtracking on inflation progress in September and October. A relatively strong economy and a jump in inflation caused some concerns in the fall that the Fed may not have room to ease, which is why we saw bond yields peaking in October. However, as inflation resumed its decline, by December the Fed was comfortable signaling to the markets that rate cuts may be in the offing in 2024. Finally, keep in mind that amid falling inflation, labor markets remained robust and the economy was reasonably healthy, which raised hopes for a soft landing. Corporate earnings are one of the big factors, in fact, that drive stock prices over the long term. As this chart shows, the earnings growth for the S&P 500 companies appears to be emerging from what market watchers call an earnings recession. And that, of course, is when there is at least 2 straight quarters of negative earnings growth. As you can see, corporate profit growth decelerated in the 3 quarters preceding the most recent quarter of reporting, the third quarter of 2023. Overall, companies struggled in recent quarters due to rising prices and global economic growth slowdown. But Q3 was more encouraging as companies recorded positive profit growth for the first time since the third quarter of 2022, aided in large part by revived consumer spending. While the third quarter growth was welcomed, it was driven by just a few sectors of the economy, and that narrow contribution to earnings growth is concerning and leaves some investors worrying about the durability of earnings growth in the year ahead. Next up, where we are now. We've looked at some of the factors affecting market performance in 2023, and now let's look at where we are now and examine the headwinds and tailwinds that could affect the direction of economic growth and financial markets in 2024. Well, let's take a look at January 2024. As the indicators on your screen now suggest, caution may be a good word to describe the economy as we enter the new year. Consumer spending, corporate profits, inflation, monetary policy, housing, mortgages, interest rates, and the leading economic indicators are all neutral. Additionally, the geopolitical risk and international economic categories are red. It seems that despite the stock market's end-of-year rally, nearly all financial indicators remain neutral as we enter this presidential election year. From those economic speedometers we just reviewed, it's clear that uncertainty is the watchword for the economy in 2024. The outcomes range is quite wide, as economic performance may turn on a few key variables. Let's look at those. That first potential headwind facing markets is inflation. While inflation has come down from its post-pandemic highs, it has remained persistently above the Fed's 2% inflation rate target. It may handcuff the Fed a bit if inflation remains stuck in the 3 to 4% range. However, at its final meeting in 2023, the Fed said it anticipates 3 rate cuts in 2024. That leads us to our next potential market headwind, which is recession, or the possibility thereof. The much feared recession did not materialize in 2023, but recessions are a natural and inevitable part of the economic cycle. They will come again. While a case may be made for avoiding a recession this year, there are still plenty of reasons that a recession may emerge. Among them are resilience of consumer spending, continued global economic weakness, especially in China, and the surfacing of the delayed impact of the steep rise in interest rates over the last 2 years. Next up, corporate earnings may be a headwind. If stock prices are to move higher, they need to improve from recent levels. We earlier showed that third quarter earnings have hinted at this recovery. The market's current valuation level may have already priced in this recovery, and should the expected growth in earnings fail to materialize, it will be difficult for stocks to rise from these levels. Lastly, geopolitical tensions are always a wild card for the markets. First, it was the unanticipated invasion of Ukraine in 2022, and then it was the conflict with Israel in 2023. Looking ahead, we see a stalemate in Ukraine, ebbing Western support, and uncertainty as to what follows in the Gaza Strip. And of course, China's muscle flexing in the Pacific region always remains worrying. One last thing I'll mention here is that the stock market is now it's looking at competition for investor dollars. With bond yields at levels not seen in decades, many investors may find that they can obtain reasonable, if not desirable, returns at less risk, leading to fewer dollars to support higher stock prices. So while the headwinds facing stocks are uncertain, they are not to be underestimated. There are several potential tailwinds that may support the financial markets in 2024, and we'll take a look at those now. One reason for the rally in the fourth quarter of 2023 was continued deceleration in inflation. If inflation maintains its downward trend, it will be a positive for stocks, since it can help increase corporate profits and allow the Fed to move ahead with rate cuts this year in 2024. The caveat here is that the Fed has said it will need to stay committed to the inflation fight, so to be determined on that. Another potential tailwind is the prospect of China returning to strong economic growth, which can have broad benefits for the global economy. China's economy has been struggling under the weight of a late lifting of COVID-related restrictions, among other factors. Nevertheless, they remain a dynamic economy that may only be a government intervention away from a recovery. Finally, there is the start of a new economic revolution, akin to electricity and computers, if you're among the most optimistic among us. Of course, I'm referring to artificial intelligence, or AI. The emergence of AI was a big story in 2023 and a major catalyst for the market. Much of the excitement was based on the future potential. This year, we may begin seeing the initial real-world impact to businesses as AI potentially turns into a new and substantial revenue stream for the AI ecosystem of providers. That's from chip makers and software companies to cloud providers through which all these AI models operate. Perhaps more importantly, we may also see non-technology companies begin wider implementation of AI in things like marketing, sales, operations, and administrative functions to drive growth, productivity, and higher profits. So now let's examine this chart to see where stock prices trend against historical averages. The most common way to do this is to look at the PE, or price to earnings ratio, which measures investors' willingness to pay for a company's earnings. Looking at the dotted line in the middle, you can see that the PE for the last 25 years on average is 16.76% for the S&P 500. You can also see that the PE moves quite a bit, with a peak near 1999 and a trough in 2008. The chart shows that the PE was 17.83 on September 30th, 2023. So the question is, does that mean stock prices will head lower or climb higher in the months ahead? That's a difficult one to answer, but it's fair to say that past performance does not guarantee future results, and the return and principal value of stock prices will fluctuate as market conditions change. Something to keep in mind for all those antsy investors out there. We've covered a lot of information in a very short period of time, focusing most of our discussion on what drove the market and what we expect to move the market over a shorter period of time. I want to end our investment discussion with a word on the importance of investment discipline, or sticking with your investment strategy. The potential of stocks to help build wealth over the long term may be challenging when investors move in and out of the financial markets. If we look at this image right now, we see a direct correlation to the probability of having positive gains in stocks with the time such investments are held. So for instance, over the last 94 years, 73% of all one-year periods had positive returns. However, if we travel out longer to longer holding periods, we see the likelihood of investment success rise to 84% for 3-year periods, 88% for 5-year periods, and 94% for 10-year holding periods. This is why we advise our clients to prepare rather than try to predict. So, what can you do in 2024 to move closer to your goals? Here are some steps to take. If your life or personal situation changes, keep us in the loop. We want to hear about important family events like births and deaths. We also care about health issues, employment changes, and any financial developments that may change your situation. If you find yourself thinking about new goals or reevaluating your priorities, share your thoughts with us so we can help you pursue the life that you most desire. On top of specific adjustments in your financial life, we also want to know how you feel about investment changes. These could be details like risk tolerance shifts or market environment concerns. Keep in mind that although your investments drive your goals are the ultimate destination. In other words, money is a tool for realizing those goals. So although investment performance is very important to us, it's not the end all, nor should we make investment changes based on market conditions. Any investment changes should be aligned with what's going on in your life and should be adjusted according to your goals. Finally, review your estate documents, beneficiary designations, and other paperwork to ensure that they're all up to date. A well-organized estate is one of the best gifts that you can give to your family. Of course, we're here to discuss any financial questions or worries that you may have. Our priority is always to help you make informed decisions and to stay on track. Throughout 2024, we will focus on delivering the following. We'll keep you informed through regular communication. We'll manage your investments according to your personalized strategy, and we'll remain abreast of economic factors and adjust accordingly. Regarding point number 2, remember, if we manage at least $500,000 for you, you have access to a financial planner who can help you create your financial plan. A financial plan is a comprehensive overview of your financial goals and the steps you need to take to achieve them. Your investment strategy drives your plan. Other important aspects of your plan can include an estate plan, retirement plan, and tax planning. If you have assets outside of Azzad, this can be a great reason to consolidate with us so you can maintain and gain more planning services. Thanks so much for your time today. As you can tell, we at Azzad are passionate about helping you understand the markets. For more information and timely updates, please follow us on social media and visit us at azzadasset.com. We hope that you enjoyed today's presentation, and thanks again.